Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta, Executive Writer at CTMfile. Joining me today are Juan Saudino, Vice President of Consulting for Treasury at HighRadius, and Jack Large, Editor of CTMfile. Thank you for taking the time to share your thoughts with us on topics that impact corporate treasury. It's time to get some deeper insights from you on our topics for today, namely increased importance of treasury fundamentals, the US Federal Reserve's 25 basis point interest rate hike, embedded finance and payments, and finally ESG. Our audience can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Let's get started for that discussion. Our first story for today is about Citigroup's new Top Treasury Priorities 2023 report that highlights three critical themes for treasurers to consider this year. First, Treasury as a value generator. Second, new ways of working and enhanced treasury skill set. And third, continued and increased importance on treasury fundamentals. Given the cavalcade of challenges that corporate treasury has had to face over the last few years, and from what you have read of the Citigroup's report, what do you recommend corporate treasury should focus on to uncover opportunities and risks and stay ahead of the curve in 2023?
Yeah, thanks for hosting us today. Looking at the Citi report, I think one of the key items is treasury as a value generator. That's been in the discussion for many years across. It has gone up and down 2 times, as sometimes following the rates or major risk events like financial crisis, rate hikes, currency devaluations. But it's always been, treasury in the past was always considered most of the companies as a cost center. And there was a lot of discussion to making them a value generator department for the company. And in the current environment, we had a lot of years of zero rate environment where there wasn't a lot of yield to be harvested on investments. A lot of folks were leaving money on overnight sweep accounts or leaving money on the bank accounts to offset some bank fees. And in the last year, we've seen probably the fastest hike of rates in 30 or 40 years in a very short period of time. So that basically, when you look at maybe the last 10 years, rates were pretty low. So people got used to use specific instruments for investments. Not a lot of value to be attained there. Now, all that the market conditions have changed. So you see a lot of treasurers and CFO now be more conscious and saying, is overnight sweep my best instrument? And can I ladder my investments into based on what my cash needs are going to be, and ladder the investments on chunks to be able to get a higher yield. Right now, we're seeing rates on very low risk instruments about 5% or thereabouts. Overnight sweeps are going up as well. That I see as a big change given the current rate environment condition that we're seeing. In addition to that, I will say the recent events of Silicon Valley Bank a couple of weeks ago, and then some other banks, Signature Bank and others that follow through. That also put another topic back in the agenda of Treasury, which is counterparty risk mitigation. Right? So now there was a lot of companies that were like on a very short period of time had to find out how much money did they have, how big was their exposure to Silicon Valley Bank in a matter of 24 hours. So Treasury normally can help a lot here on providing almost real-time data into where your cash is sitting for you to understand your exposure. So we'll see a lot of things changing soon here. There's a lot of discussions about having just one counterparty or hedging your counterparty risk in the sense of having more bank relationships that also will allow you to, if you need borrowing facilities and you're not getting a slow response from a counterparty, you have another relationship with 2 or 3 counterparties that you can tap into and move quick. So there's a lot of discussions around that. I think treasurers will need to start looking at this and pay a little bit more attention on where they assign their funds. I was talking to a CFO a couple of weeks ago. There's instruments right now where you can invest in an overnight sweep, and then that company can basically split the money across multiple counterparties, so you stay within or below the FDIC limit. So those kind of funds are insured. So there's a lot of changes going on. I think at some point, maybe the FDIC should reevaluate the limit, 250K, because right now there's instruments in the market that allow you to, like the one I just mentioned, allow you to split your funds across pretty quickly across multiple counterparties. So essentially you're getting that higher insurance beyond 250K, but just through maybe an operational hurdle or inefficiency here.
What's most important, I think, about this report is it's the best one from Citi for several years. The Treasury Priorities Report has been a mainstay in reading, but this year I think this report, every corporate treasury should download a copy, set a checklist and say, am I doing the right things? Am I optimizing my working capital? Am I finding new ways of working and using the Treasury's skill set? And then don't forget the fundamentals. That third point is so important. It's those fundamentals don't go away. Just because we're going through a low interest period before now for a good few years, people forgot the fundamentals of that Juan has been describing about having to control your cash and optimize your working capital. This report is very, very important in my opinion. It's at the end, they talk about ESG and the importance of being more cognizant of their environmental responsibilities, yet their insight showed that only 20% of KPIs have any relevance to the environment control. So they're all saying grandly, yes, 70% of us think it's important. But when you look at the KPIs, it's only 20%. And that's what's missing at the moment for me. But overall, I recommend the report entirely. It's a very important read.
Yeah, I agree with that, Jack. On the ESG discussion, is everybody's saying that is important, but if there's no KPIs, people are going to have other priorities, right? And there's always something that comes up urgent that needs more attention. And if you don't have a KPI at the end to measure how well you're doing to that important aspect, then this is not going to get done.
Exactly right. I'll listen to your strategic goals, but can I see your KPIs? That'll tell me what your real goals are. Exactly.
Yeah, and the other thing, I also agree with you on optimizing working capital. It's always been on people's minds saying, yeah, I need to optimize my working capital. I need to find ways of decreasing my DSO through a collection program, using AI about how to collect faster and contact customers quicker to reduce DSO. And then also looking at ways of managing your AP and trying to lay as much as you can your invoices in a way that it doesn't disrupt your business. So that's been always in the agenda. The thing is, it becomes a lot more costly not to do that, or not to do that efficiently now, given that there's the opportunity cost of not having those funds available to invest. It's higher given the rates. From an operational perspective, it's always been important, regardless of the rates, because that's more cash they have to work with. But right now, if you can get into an idle cash situation, then you get more money for your buck with the current rate environment.
The report was very neat about how it described that aspect that Juan's it's taking Treasury as a value generator. That's the key piece in strategic terms. And then the other piece is about new ways of working and enhancing treasury skills. Yes, that's there and in continuing, but focusing on treasury as a value generator is fundamental.
Yeah, no, I was going to say the other item that is important when in terms of how the new ways of working, and there's two aspects of this. One is COVID has brought up to what used to be back in the day a disaster recovery plan, right? Treasuries will have once a month, everybody will work from home one day, and to see if something happens, if we need to work remotely, can we actually operate, make payments, do trades, and so on. That used to be like a black swan event. Then all of a sudden, in a matter of a week, we went to that being the normal, right? That disaster recovery became the normal for a long period of time. So what that did is that proved Treasury and companies in general that there's other ways of working. And I've been in the consulting space for many, many years. We used to travel like every day of the week for like the full year visiting customers. Technology has changed that in terms of we have Zoom right now. In the past, we probably would have done the same environment. We probably would have gotten together on this podcast, sit down around a table and record it. Now we have tools that enable that collaboration to be done remotely. So there's a component of working in Treasury that includes a hybrid work environment. And there's also a component driven by technological advances. And what I mean by that is the reports talk about optimizing working capital liquidity forecasting. There's tools, for example, at HighRadius, we're using tools around AI and machine learning around cash forecasting. So those tools, such as AI and ML, we've recently been a lot of adoption around ChatGPT, people using that. And when you talk about technology adoption, that's probably been the fastest. It went from 0 to 100 million users in a matter of a month. So, and as people starting to test these new technologies, we still don't know what the end impact is going to be. I'm guessing in the next few months, we'll start seeing some applications around Treasury. But all those technologies essentially change the skill set of the folks that need to work now on Treasury, right? And back in the day, it used to be if you're pretty good at Excel, you'll do well in Treasury, right? Now, then we move to systems, ERPs, bank connectivities, Treasury management systems. Now we're layering analytics on top of that, AI, machine learning. So there might be some minor coding involved that people will benefit, or Treasury folks will benefit from knowing. And now we have full-blown AI through ChatGPT. So there's a change in the way we work in terms of remote, hybrid, full time in the office, and then the technological stack that will up the game for the resources in Treasury to stay current.
Those are great points. One, if I may ask you a follow-up question, you mentioned some very interesting aspects in terms of counterparty risk, concentration risk, bank failures, cash flow forecasting, machine learning, AI. Given that we are still in the wake of the recent bank collapses and failures, and we're also in an AI-driven world, what at HighRadius, or generally from your consulting experience, is there any specific tip or measure or step that you could recommend that would help corporate treasury improve their cash flow forecasting and or cash visibility, particularly in the times that we live, which are very uncertain?
Yeah, there's a very good point. So there's, I'll say two main points regarding to counterparty limit and cash forecasting. One of them is, given the recent situation with SVB and other banks, it is important to know, and every CFO and treasury will have this question, and they need to answer, how much money do I have and where is it? And the where is it sometimes can be, is it on counterparties? Is it on companies that have some restricted funds? Is it on countries and currencies? Because once you have the answer of, well, how much do I have? Okay, if I need it, how quickly can I access to those funds, right? And if you have money in a country where it's very hard to get money out quickly, then knowing that and knowing what that breakdown of your cash allocation is through time, it'll allow you to make decisions in terms of, do I need to put a polling structure? Do I need to do a multilateral netting process to get quicker access to those funds? And then the other component to that, that's the immediate answer, right? How much cash do I have right now? Do I have a big part of my chart in SVB, and this is Wednesday or Thursday 2 weeks ago, so you need to rush. Hopefully it was Wednesday or Thursday, not Friday, right? Because then you might not be able to get your money out. So that's become critical due to the recent events. There was a lot of policies and assurances to make that maybe a less of an issue going forward, but I don't think we're still out of the woods on that. So people are now overly cautious. We can get to a point that everybody moves their money to the top 5 banks, right? Because that's not the best for anybody. But there's people talking about that. So we need to find a middle ground on that. When it comes to cash forecasting, there's definitely tools out there, because it's about knowing what your forecast is going to look like in the next 3, 6, 9 months, but also the level of accuracy, and can you trust the forecast to make like investment decision today? We're talking about doing investment ladder. So can I trust my forecast with a higher degree of confidence that I can invest money and lock it in for the next 3 months? And I'm sure that I'm not going to need it earlier unless something like a black swan event happens. And we're using artificial intelligence and machine learning to do that at HighRadius for cash forecasting. I will say one of the key components as well is folks also starting to understand the data sources. And the data is critical, right? So we've seen it with ChatGPT. There's some good applications, but the data set is being trained with internet data up to 2021. So if you ask a question, what are the rates right now? You might not be able to get a good answer. So the data is important. Data set that you're starting from is important. And then once you have a good grasp on that, you can use the technology stack to empower you and augment your accuracy and skill set.
That is, I hope our audience has listened to your wise words. That should be of tremendous benefit to them. The next story that merits discussion is the US Federal Reserve, or Fed's 25 basis point interest rate hike to maintain the delicate balance between price stability and financial stability. Jack, if I may ask you to go first on this, how do you think the Fed's latest rate hike will impact corporate treasury?
Make them more cautious. I think there's no doubt about that. The caution comes in 2 areas. One, how they choose banks and use banks, and managing the flows and the funds between the banks. That's one point. And the other point is that the investment in projects, and I was talking to a corporate treasurer last week, and he was saying, we're very cautious. I'm worried. One project's been put back 3 months. Another one has disappeared. It'll reappear, but it'll only reappear once things have settled. I mean, I highlighted the comment by Ryan Brandham from the head of global capital markets, saying that Powell, the head of the Fed, has threaded a needle to be able to get that through. In other words, he's been very cautious, and we're seeing exactly the same thing inside the UK and across Europe. So everybody's being very cautious. Don't go asking for lots of investment unless you have got a really good case for it.
Juan, would love your perspective on that as well.
Yeah, so I agree with that statement. What I think it's also, there was a lot of folks thinking that because of this bank crisis that we experienced 2 weeks ago, that they were not going to increase the rate. So there's a very tough balance right now between taming inflation and just at the same time just being cautious of not causing financial stability in the banking sector. So I agree. I mean, treasurers are extremely cautious right now. They're looking at projects that really can provide value quick to the business, and then they're just waiting and seeing, because a lot of folks were banking on 0 increase in the last meeting, and we got 25%, 25 basis point, which is, it's a small increase, but it still shows, and that it's in the direction of rates will keep increasing. And inflation, I think in the last count was about 6%. So part of the way of taming that down to the target that they have of 2% is probably keep increasing rates until they get higher than the rate. And then, but that they need to balance that with a soft landing and not crashing the banking sector.
The worrying thing, though, is that the thinking behind inflation control is changing. The economists no longer all agree that the way you do it is by putting up interest rate, and that will control inflation. There are quite a few economists now are saying, not sure that reasoning's right. So the inevitable consequence of all of this is corporate treasurers just need to be cautious.
Corporate treasurers need to be cautious. Moving on from caution to our next story that revolves around SAP Fioneer, a provider of financial services, software solutions, and platforms, has announced the launch of a B2B embedded finance platform facilitating orchestration between SAP users and financial service institutions. Embedded finance and payments have become a core part of value propositions offered by businesses to their customers by enabling personalized, frictionless, and instant payments at the touch of a button. One, do you think there will be an increased adoption of embedded payments? And if so, will it pave the way to greater opportunities for corporations and the financial services industry at large?
Yeah, I think there will be a bigger push for embedded finance in the short term, and we're seeing that on the consumer side, right? So right now, you buying something, you can buy now and pay later. There's companies like Affirm that can offer financing. So it's gonna come, and it's gonna be more adopted on the B2B side as well. There's companies, for example, that are now with the be more cautious about cash, and the ones that are more strapped for cash, will they be looking to sell invoices and use portals where they can select a batch of invoices, sell them, and get money quicker at a discount? So I think there's room for a lot of those integrations with financial institutions. Another area that can be an opportunity is banks and financial institutions that lend money through asset-based lending. Can they get a more up-to-date by connecting to the ERP and getting kind of almost real-time assessment of collections and inventory and things like that? So I think there's going to be a good push on this area down the line. Payments we've seen right now, as consumers, we can pay with a click of a button. I can send you money through Venmo and any other applications. The B2B side is moving to a real-time payments as well, slowly but surely. So there's definitely a lot of opportunities in the near future for embedded finance applications on the B2B world.
What interests me about this story is how it makes corporates become increasingly independent of specific banks, that they can use the embedded finance functionality to switch banks to third parties, specialists, and only do their core banking. I see this as a threat to the banks. SAP tried to get into the payment business famously to take over all connectivity between corporate and the banks in terms of payments. This is another encouragement by SAP to introduce additional services that they can use to become more bank independent, more autonomous. I think it's very important. It's going to live or die as to how easy it is to use and how efficient it is. We'll see.
Yeah, I think the key to this will be just to, as you said, Jack, efficiency and ease and speed of implementation. A lot of companies have gone through multi-year projects to implement functionality in some areas. This needs to be a very nimble approach in terms of implementing faster and getting value quicker. That's when we talk about raise, we could talk about treasurers and C-level being cautious about the projects that they embark on. Projects that have a payout of 2 years of implementing an application with this rate environment and being cautious, they need to provide a lot of value. And it's going to take 2 to 3 years to get that value. So speed of implementation and realizing value quicker is going to be at the top of the agenda as well, I think.
That's always been the problem with SAP related applications in my experience.
Our fourth story for today is about Asian companies willing to allocate up to 20% of their operating budgets to ESG, according to the DBS Catalyst of Sustainability report. With the introduction of Scope 3 emissions and reporting standardization, ESG will be the one to watch in the future for Treasury. But given the recent US bank failures, Jack, do you think ESG will see a shift in focus from E to G or environmental to governance?
The first point I'd like to make is that this is a minor increase in the Asia's. It's only 2% increase from 18 to 20%. It is not that important yet, but they are getting cataclysmic floods, as in Pakistan and so on. So this is going to change. I think the governance is actually going to have to change as well. I was talking to a retail supplier last week, and he was saying that they'd got some data showing that the governance inside one of their suppliers was such that they were really upsetting the employees, but they don't know how to deal with it. And so governance is going to increase, but environmental pressures are going to be by far the biggest, in my opinion.
Yeah, I agree with that. So what I think will happen is long term, the agenda of ESG, as we discussed earlier, everybody thinks it's important. KPIs are not showing that everybody thinks is that important. So there's going to be a alignment of what they're saying versus how they're tracking it. And then I think what's going to happen is when we have crises like the banking crisis that we saw a couple of weeks ago, we're going to switch from E being more critical at this point to maybe G. Now it's a capital G, lowercase e for the time being. And as you move forward, try to just push consistently on all three fronts, but some events will push you to, at any point in time, pay more attention to one other than the other.
Don't ever forget E. Environment is the driving force. There's no question about it. It's just whether the politicians and the business people acknowledge it soon enough.
Agree. Yep. That's a big component, and there's a lot of companies pushing in that direction. I think we've seen it with energy. We've seen it with electric cars. There's advancements in energy that will hopefully bring the energy cost through solar and wind to very close to zero, which that will unlock a lot of other values in the economy and companies and specifically also countries to lower the energy cost to be more productive.
Finally, what is your choice for the biggest or most important story of the past week, and why? Jack, if I can ask you to answer that first.
It's the outstanding contribution this week has been the Citibank's story of their fundamentals. And I just read the fundamentals that in this very, very good write-up of this report is the fundamentals of focus in 2023 have to be cash visibility and accessibility, liquidity centralization, and simplification and rationalization of bank accounts and relationships. I found it rather amusing Citibank was saying that, because quite often when they ask that question, they exit Citibank fast, but I remain to see what happens. But this report was fundamentally, if you've not read it, get it and read it.
I agree with you, Jack.
Yeah, I will agree with that too. I mean, that bringing to the forefront of Treasury cash visibility, we said is important, knowing where your cash is, streamlining your working capital and your cash conversion cycle, having a accurate and forecast that allows you to make better decisions with more confidence, and then rationalization. That's been on the agenda for quite some time. A lot of companies trying to reduce number of banks. I think at some point the goal was trying to get to a minimum, hopefully one. Now we've seen one is probably not the best idea based on what happened with SVB. So there's a middle range, maybe 3 to 5, and this will depend on the global footprint of the company. Sometimes you need to rely on global and sort of local and regional banks, but just minimize because there's a lot of fees, there's a lot of process inefficiencies of moving cash around and costs that you can unlock in the business.
Thank you so much, Jack, and thank you, Juan, for your time, your informative analysis, and valuable insights. I, for one, have benefited a lot, and I really hope our CTMfile audience has as well. We would like to thank them, our CTMfile audience, for joining us on this edition of Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you so much. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.